It's a pleasure to be here this afternoon to walk you through some of the highlights that we've seen across CSL, and obviously part of what I'll do is also paint you forward where we see the end of this year coming out and the guidance that we've given to the market, but equally give you a little bit of background around how we've got to this point in the current year. So just looking at the first slide and giving you a little bit of an overview of CSL at a glance. And whilst most people who follow the stock understand that we're the number one player in the plasma therapy side of things, the thing that a lot of people have been focusing on more recently is obviously the influenza business, the Seqirus business that we acquired in 2015. And we are the number two player in that market today. Clearly, it is a business that we're still in the process of turning around, and I'll walk our way through that. Equally, we continue to actually leverage the DNA that sits within CSL alongside our research and development capability. It is the fundamental linchpin that we actually have as an organisation, and we continue to actually look to develop the product portfolio that we have and continue to spend in excess of $600 million US dollars into research and development across the whole company. Interestingly, looking at this slide, and it sort of creeps up on you when you look at it, we now have over 17,000 employees globally. A fair number of those sit in the plasma collection centres that we actually have. It's close to about 9,000 in our plasma collection network that we actually have. And obviously, last year's financial results, you saw that we actually delivered over $6 billion US dollars in revenue. We do sell now through 60 different countries globally. We have a physical presence in around about 30 countries globally, and we continue to look at how we can broaden that reach that we actually see across the total globe. Obviously, we are very heavily, and I'll talk about it in a slide shortly, very much focused in both the North American markets and also Europe as our key areas, but we continue to access a number of new countries as part of the group. I mentioned earlier, obviously, the strong R&D capability that we actually have. What you can see here is we did invest over $2.3 billion US dollars over the last 5 years into our research and development portfolio. As I said earlier, in the 2016 financial year, we invested some $614 million into R&D. We now have over 11,000 employees in that part of the company. The bulk of the research is still based here in Australia, and I focus there on the research side of things. We do have 30 collaborations with universities globally in our research area, and a fair chunk of that is actually sitting in our Bio 21 facility, which is part of the Melbourne Uni facilities that we actually have in Parkville in Melbourne. So from that side of things, the whole part of the company starts with collection of plasma. We now have over 160 centres as at the end of December, and I should say that today we have been adding around about 30 centres for this financial year. So from December, we've continued to grow the number of plasma collection centres that we have globally. We are still the most efficient in collecting plasma globally, somewhere around about 20 to 30% lower cost versus our main competitors in relation to collection of plasma. And that still represents around about 50% of our overall cost of goods sold. And of that, half of that, generally speaking, is in relation to our donor fees that we pay. So around about 25% of our cost of goods is donor fees. So it's a key part of the business that we need to continue to expand and grow. If we're not collecting the plasma, then we don't have the ability, obviously, to make end product. And a key focus for us is on that part of the business. I mentioned earlier just around, we also continue to look strategically, where do we want to take the business and moving forward. We have up here our 5 key strategic objectives, and I'll touch on these as I work through the rest of the presentation, but they are very much around growth. We need to continue to look at how do we optimise the portfolio of product offerings that we have out into the market. That's about ensuring that we bring new products to market. We continue to look at new indications for existing products, I should say. And we have had in the last 12 to 18 months a number of new product launches, and it's key that we actually get there, optimise those new products into the market. Efficiency is the foundation for the company as well. We are, as I said earlier, the most efficient and highest quality plasma player in the market. That gives us a competitive advantage, and we need to continue to obviously leverage that position that we have, not take it for granted, but continuously look for improvements across the plasma network. The influenza business, the Securus business, is a business that is in turnaround. We certainly said that when we acquired the business back in 2015, we knew that we were acquiring a loss-making business. We set some goals back at that time around getting the business to break even in financial year 2018, and we have not varied from that and reaffirmed that that is a break even net profit after tax for the financial year. Some people have asked, is it a run rate when we exit the year? Is it, actually in the year or not? We are saying for effectively next financial year that we would expect that influenza Securus business to be break even at an NPAT line. Now, I will say up front, you won't actually get to see that, because the way we actually report our results is we give out to EBIT side of things. So you would be expecting to see a positive EBIT for the business. We then treat interest and tax at a global level, but effectively we're saying that that will be break even in financial year 2018. Mentioned it earlier, just the focus on R&D. That is about the innovation side of things and about continuing to diversify and enhance the growth options that we actually have as a company. I would also just say that whilst R&D is a foundation, we continue to look for innovation outside of just the research and development area. So even in our operations, we're constantly looking at how do we refine what we do to get that incremental yield that we need out of our production facilities. And having said all of that, none of this is actually possible if we don't continue to invest in our people and develop the right culture across the company. One of the things that we are very pleased about is the patient focus that we actually have across the company. And that comes to largely the culture that we see, and it enables us to attract, retain, and develop the best talent that we see in the industry. And from my side of things, one aspect that goes with that is we're able to get discretionary effort out of our staff because of how they align with what we're ultimately doing as a company, which is about saving patient lives and extending and giving people drugs that enables them to lead a better life as such. So just looking at the overall sales for the half year in 2017, just over $3.6 billion for the 6 months to the end of December 2016. And really what I just leave you as a takeaway here is that if you're looking either at the product portfolio side of things, which is on the coloured graph on the left-hand side there, or you're looking at where we actually sell product into, we have a good mix, both from a product portfolio perspective and also from a regional geography side of things. So that means that we're not overly dependent on either one country or overly dependent on one product group as part of that. So that gives us a good amount of risk mitigation through the overall portfolio that we have. The one thing on the geographic side of things that quite often surprises people, given the origin of the company, is just the level of sales in Australia. It represents 8% of the business. As you can see here, 50% of the business is in North America, both Canada and the US, and Europe represents 24%. So they're the key markets for us. It is where we obviously spend a lot of our attention from a sales side of things, but as you can see in Australia, it's around about 8%. Over on the overall product side of things, and I'll talk a little bit about some of the specific products in each one of those categories in a second, but what was interesting for the half just gone was the strong growth that we saw in our specialty segment. And what you can see here was that was some $590 million, and for the first time actually exceeded the haemophilia sector. So we did actually see some good growth come through in the specialty side of things. Generally better there. The specialty products for us, as a general rule, are very high margin products, and the reason behind that is largely through the cost of goods, which is the plasma collection side of things. We get a return out of selling the IG product, so the items in blue there and also the albumin, and then effectively what we're paying for from a cost of goods side of things in the specialty and even in the haemophilia, plasma-derived haemophilia products, is we're just having to do the last stage of fractionation, purification, fill and finish. So both of those segments, as a general rule for us, are very high margin business. So again, just a bit more detail on each one of those segments for you and pulling out some key highlights. So on the IG side of things, we saw 22% growth in a constant currency basis for the first half. A fair bit of that was around good growth in our Privigen, which is our main product that we actually have. So this is the intravenous IG product. What we did see there was some really good uptake in the US alongside the hospital sector for us. And what we also saw was a bit of a change in our focus from a sales perspective. We did see some, as we described in the half year, atypical market events whereby some of our competitors did actually stumble in the first half, and we were able to step in and fill the void there. Now, I know one of the questions that we constantly get is, and I'll get to it when we talk about guidance, is, how does that play out in the second half? How much of that have you actually been able to keep? Where are the competitors at? The thing that I would just sort of draw your attention to is we were able to meet that and sell the 22% growth on the back of the fact that we had inventory available to put into the market. So we've always said that underlying business growth in the IG space, which drives the business, is in the order of 5 to 8%. We see ourselves as the most efficient plasma collector in the market, that our right, if you like, or what we're targeting to do is grow ahead of the market. So we're looking to grow somewhere between 10 and 12% for our collection side of things, and I'll show you some slides on that in a second too. But as part of that, we were able to step in because we actually had built up some of that inventory side of things. What I would just preface is, even if the market demand was there in the second half at sort of 22%, we wouldn't have the inventory to fill it. And so that's a key part. Understand that this industry has a very long supply chain. So from the time that a donor walks into a plasma center in the US and donates to the time that we ultimately have product available is around about 9 to 10 months. And that's not because we're inefficient. That's because at the end of the day, there's a whole lot of regulatory requirements to actually hold inventory, rescreen it, go through the quality side of things. So we have a very large supply chain as part of that. And so that just gives you some indication that what we have today and we're collecting today is only going to be sold in that 9 to 10 months out. So if we don't have the inventory now, we won't be able to step in if there was a market shift. So Privigen, as I said, grew very well for us. It also grew well in Europe. But the other product in this space that we're very pleased with is Hizentra. Now, Hizentra is our subcutaneous IG product, which actually enables patients to self-administer at home. And that way we're actually allowing patients to take more control over their disease by self-administering as part of the process. And Hizentra grew at 14% in the half, and that was on the back of some 31% growth in the prior year. And of that growth in the prior year, about half of it was volume and half of it was price, and the 14% this year was largely volume. So that's continued to grow well. In the haemophilia space, as you can see here, constant currency growth of 2%. Now that has a large mix effect in there. Our two new recombinant products, Idelvion and Astilla, have been launched into the market, and we are seeing uptake as part of that. Idelvion is a game changer into the haemophilia B market. It is registered for 14-day dosing, and at the end of 14 days, we're seeing trough levels well above 5, in some cases up to 10%, and we're seeing 0 breakthrough bleeds. Now, that is a step change for therapy for haemophilia B patients who traditionally would have been having 2 to 3 injections a week, and they're now out to 14 days. And that has been launched. We're getting very good feedback from the patient fraternity, and that is a key growth area for us. We did see that originally sort of being targeted at around about 30% market share. We would say now, that given the feedback that we've got, that we think that we can probably do better than that in the market. Avstilla is our factor 8 product. Again, our own developed recombinant product. Now that is a lot harder. It is hand-to-hand combat in that market. It's a competitive product, but it is not a differentiated product. Now we currently have Helixate, as you can see up here, which is a product that we distribute from Bayer. That distribution arrangement ceases at the end of this calendar year. And whilst we'll still have some stock to sell into next year, that product then will go off the market. So patients that are currently on Helixate have to make a choice as to where they go to next. And most of them are looking to actually go to the next generation of recombinant products. And that is where Avstilla plays into the market. And so we're in fighting for that aspect. The key thing that I would just leave you with is that Helixate as a distributor product, we make about a 10 to 15% margin on. When we go to Avstilla, which is our own product, that at the moment is being made by CMOs, so contract manufacturing organisations, and we are looking to ultimately bring that in-house from a manufacturing side of things. We get around about 3 to 4 times the margin being our own product. So the point behind that is we don't need to replace all of the sales to end up with the same economic outcome. And that's partly why you do see that the haemophilia only grew at 2%, because we're seeing some drop-off in the Helixate sales. The specialty products grew at 25%, as I mentioned earlier, very high margin products there. We did see Kcentra, our product, we changed our sales approach on that product. What we were able to do is get better penetration into the hospital market in the US. And that was the one that surprised us, quite frankly, as well, a little bit over our own expectations. So that has gone extremely well into the US market, principally in the hospital side of things. Equally, we did see Berinert, which is into the HAE market, benefit from a disruption that occurred with Shire, who have the main product from a prophylactic use in that patient area, whereby they did have some supply issues. And so Berinert is a product that works, but it is currently on-label use only on an acute basis, so not for prophylactic use. But when you're a HAE patient who is taking product prophylactically, you need to continue to obviously take product, and the competition stumbled and didn't have availability. So we know that what was happening was clinicians were actually prescribing Berinert. And we saw a bit of an uptake from there. And I'll come and talk a little bit further about how we see that HAE market in a second. Albumin sales continued to grow well at 19%, largely on the back of China, which continues to be the main area of focus for us there. And that continues to actually pursue and meet our expectations. We certainly aren't constrained in sales into China. We could sell more product into China if we had it, but we obviously limit the amount that goes in back to the IG growth. So every litre of plasma we get, we need to actually produce an IG product, and we need to produce an albumin to get the return. So we're not going to go out and collect plasma just to meet the China albumin market as part of that. And then the Seqirus business saw a 14% increase in sales, largely on the back of an improved influenza season over the prior year. Just talking about plasma collection for a second, and this, as I said earlier, is the key part to what we need to do for the company. And we have constantly talked about what we're doing in the market around collections. Now, this is a slide that's focused on collection centres. Now, I would just say to you, it's not the be-all and end-all of collection, but it does give you a clear indication of just where CSL has been growing over the last 5 years versus the rest of the market. So you can see here the compound annual growth rate for us in opening centres is 18%. The market's grown at about 8%, but if you take us out, the rest of the industry is growing at 6%. So the point that we're actually saying there is the rest of the industry is not growing to keep up with market demand. And we see ourselves as being the most efficient in this space and actually looking to take a leadership position by actually pushing that through. Importantly here, to open a centre takes around about $2 to $3 million to open a centre from a capital perspective. It does take us around about 2 to 3 years to get a centre to its optimum level. Now we have, as I said earlier, over 160 centres. We know what the optimum level looks like. We also know the demographics that we actually look to get to open a new centre. We certainly don't feel as though we've saturated the US market. There is still centres that we see that we can go to, or areas that we can still go to open up centres. But importantly, what we also see is over the medium term, that when we get those new centres up and running at the most efficient basis, there is downward pressure on the donor fees. At the moment, we're pushing our centres extremely hard to collect as much plasma as possible. So when you're doing that, you obviously need to incentivise the last donor into a centre, and that comes with a little bit of pressure on the donor fees. But over time, we would expect that to actually step back as we start to get some more efficiency through our centre side of things. Mentioned earlier Seqirus and just where it is in relation to the turnaround. Key thing here is really to look at that middle block here, whereby what we have been able to do now is change largely the portfolio of products that we actually have to sell in the market. Traditionally, and when we bought the business from Novartis, we were selling the trivalent product, so a 3-strain influenza vaccine. The market had moved to quadrivalent, QIV, largely led by Sanofi, who are the #1 player, and also GSK as the 3rd player in the market has also moved across to quadrivalent. And what we need to do to turn the business around was actually get quadrivalent products approved and then look to get the uplift that comes from a margin perspective. To put it in some simple terms for you, trivalent historically has sold for around about $6 a dose. The quadrivalent sells for about $11 a dose. And it doesn't take us $5 to make the extra strain. So what the business was about is getting those quadrivalents approved and transitioning what was our existing doses of trivalent through to quadrivalent and getting the margin uplift as part of that. So we're on track to do that. We now have Flucelvax, which is coming out of our Holly Springs operation as a QIV registered for ages 5 and above. We have a Fluria, which is our egg-based quadrivalent product approved now for 18 and above. And we also have Fluad, which we see as being a differentiated product into the market because it is very much targeted at the elderly and the young. And what we do is we put an adjuvant into the vaccine that gives a boost to those areas or the population that actually are a little bit less on the immune system and need that extra boost as part of it. And that again sells at a premium product price. Now, currently, we haven't got Fluad as a quadrivalent. We have it as a trivalent product. And what we still need to do is get all age indications for both Flucelvax and a Fluria. And that is something that we see playing out through to 2019. And then at that point, we'll be able to optimise our R&D spend. And versus what we did have back in 2016, we'll take between $50 and $60 million out of our R&D spend once all of those age indications are actually through. If you jump through to the target into 2020, that you can see there are $1 billion in sales at a 20% EBIT margin. Most of that leads to Holly Springs, and we need to actually improve our yield and efficiency coming out of that plant. For those that aren't aware, that facility was built by Novartis and the US government for $1 billion US. $400 million was tipped in by the US government, $600 million was tipped in by Novartis. We bought that facility plus the Liverpool facility in the UK for around about $280 million. So well below replacement value. It at the moment though is the part of the Seqirus business that loses money. And we need to turn around the efficiencies on that to actually drive that forward. So that's the key thing to get to that 2020 picture. Just looking at the R&D, as I said earlier, this is a foundation for us alongside continuing to stay ahead of the competition and develop our R&D portfolio. I really just wanted to pull out a couple of items on this slide. The first one is just up the top. You can see that both in 2017 and 2018, Privigen and also Hizentra into CIDP. CIDP today represents around about 30% of sales for IG. Currently, we do not have that on label in the US. We do have CIDP indication in Europe, for Privigen, but we've been going through the process of having it approved for both Hizentra and Privigen. And once that's on label, that'll enable us to get into the neurology segment of the IG space, and we see that as potentially good upside for us in relation to that product. The other one that I'd just like to draw you down to is in the specialty area. That you can see here, it's CSL 830 or HAEGARDA. I mentioned earlier Berinert into the HAE patient fraternity. What HAEGARDA is a subcutaneous application, which again would enable patients with this rare disease to be able to treat themselves at home, and that really does fit with the prophylactic use. We currently don't have access into that market with a labelled product, and we do see this as being a substantial step forward. Currently, the product that's being used there is a Shire product called Cinrise, and what it has is about a 50% reduction in occurrence rates for that disease. The data that's out on HAEGARDA that's been published in the New England Journal of Medicine indicates that we have somewhere between 85 to 95% reduction in occurrence rates. So a step change in therapy to what they're actually currently seeing at the moment. And we think that will be a good market for us. To be totally upfront around it, we're about 12 to 18 months ahead of Shire, who have a product coming into the market, which is also a subcutaneous product into the HAE space. But we believe that first mover advantage will be significant and enable us to actually significantly gain some share into that prophylactic part of the HAE market that we currently are not operating in. And then, as I said earlier, if you just look down the bottom in the purple, by 2020, we've actually got all age indications done on the Seqirus part of the business. So bringing us to where do we think that we're going to be at the end of this financial year? And we do see continued strong demand across our plasma therapy products, and that remains a focus for us. The launch of Idelvion and still is playing out in relation to growth that we see in our recombinant coag products into that haemophilia part of the portfolio, and that continues to be material from a margin perspective, especially because they are higher margin products than what we've had historically into that part of the product offering. And we continue to focus very much on the Seqirus turnaround and just seeing where that goes. So that all leads us to an NPAT growth of some 18 to 20% is the guidance that we've given on a constant currency basis. And that's off the back of the prior year results once you take out the noise that was in the result in relation to the Novartis acquisition, both on a cost and a gain on acquisition. We have announced and we're in the process of doing a 500 million Australian buyback. As a result of that, you would clearly see that the EPS growth will outstrip what's actually happened on the NPAT growth as part of the overall group.